Today, we're diving deep into the latest quarterly results from EMS Ltd, a really key player in India's whole water and infrastructure scene. And let me tell you, their Q2 numbers, they didn't just miss expectations. No, they sent a real shockwave through the market, and they've got everyone asking some pretty serious questions. So let's get right into it and unpack what's really going on.
Okay, let's just start with a number that made everyone sit up and pay attention. A 37.5% drop in standalone operating income year over year. I mean, just think about that. For a company that's known for its strong growth, seeing a decline that sharp, well, it's the kind of thing you just can't ignore. But believe it or not, that wasn't even the whole story.
Because the bottom line, the actual profit, got hit even harder. We're talking a 43.4% plunge in standalone net profit compared to the exact same quarter last year. Now, when you see both your revenue and your profit fall off a cliff like this, investors, analysts, everyone starts asking the same single, crucial question.
Right. Is this just a temporary setback? A perfect storm of bad luck that's just going to blow over? Or are these numbers pointing to something more fundamental, a deeper issue with the company's operations, maybe even its market position? That is the mystery we are going to try and solve today.
So to get to the bottom of this, here's our game plan. We'll first break down this Q2 storm. Then we'll listen to what management has to say about it. After that, we're putting the financials under a microscope, analyzing their roadmap for recovery, and finally, we'll zoom out for the long-term view, looking at the company's track record and its new leadership.
All right, so when the numbers are this startling, the first thing you always want to know is what's the official story? What's the company saying? And in this case, EMS management didn't beat around the bush. They pointed the finger at one single, very powerful culprit, the monsoon.
During the company's earnings call, the brand new CEO, HK Consul, was incredibly direct about it. He straight up attributed the terrible performance to an unusually intense rainy season that hit pretty much all of India and just completely disrupted their work. He even made a point to say that while Q2 is usually a bit weaker for them than Q1, this year was way, way worse than normal.
And look, this wasn't just some off-the-cuff remark in a call. The company's official press release completely backed this up. It laid out how prolonged, heavy rainfall led to some major operational headaches and safety risks. So the question is, how does rain literally stop a multi-crore infrastructure company in its tracks?
Well, it really comes down to the kind of work they do. A huge chunk of EMS's business is all about laying underground pipes for sewerage and water. The very first step, always, is digging these massive, deep trenches. But you can imagine when unexpectedly heavy rains pour down, those trenches fill up with water. This creates a huge safety nightmare. The soil gets waterlogged, it can collapse, which is a danger not just to the workers, but to nearby buildings too. So, for obvious safety reasons, all that underground work has to grind to a halt. But here's the kicker. The work stops, but the costs don't. You still have your labor on site, you still have all the heavy equipment there just sitting idle, racking up expenses day after day without generating a single rupee of revenue.
Okay, so management's explanation about the monsoons, it sounds pretty plausible, right? It makes logical sense. But, a proper evidence-based analysis means we have to look past the story and really scrutinize the hard data. So, let's put these numbers under the microscope.
This table really just lays it all out in black and white. You can see the operating income dropping from over 230 crore rupees down to just 144 crore. But I want you to look even closer at the EBITDA line. That's earnings before interest, taxes, depreciation, and amortization. It's a really key way to measure a company's core profitability, and it just cratered by almost 44%. Now that tells you the problem wasn't just lower sales, it was a fundamental blow to their operational efficiency during the quarter.
And seeing it like this, as a chart, really just drives home the sheer scale of this drop. It's not a dip, it's a cliff. But beyond just the headline numbers, this whole situation sparked a really crucial debate on that earnings call about something just as important: profit margins.
Now, this is where it gets really interesting, because an analyst called them out, and rightly so. He said, hey, historically, your margins have been up around 24–25%, but now you're guiding for 18–19%. And the CEO's response was super important. He clarified that the analyst might be looking at a number that includes other income, like interest. He insisted that the core operational margin, the profit they make on the actual work they do, has always been around 20%. His key message here was, yes, revenue collapsed, but the profitability of each project we have is still intact.
So there you have it,
A really disastrous quarter explained away by the weather, with the company insisting its underlying profitability is still holding firm. That's the story of the past. So now let's pivot and look at their recovery roadmap. Let's see exactly how they plan to pull out of this nosedive.
And this is a bold one. Despite that Q2 disaster, management is absolutely sticking to its guns. They are forecasting 18 to 20% annual revenue growth for the entire fiscal year compared to last year. Now, that is an incredibly confident claim to make after losing so much ground. So the big question is, how on earth do they think they can achieve that?
Well, their whole strategy now hinges on what you'd call a massively back-ended year. The CEO explained that in a typical year, the first half makes up about 40% of the revenue. But because this Q2 was so weak, this year it's only 33%. You see where this is going? That means they now need to generate a whopping 2/3 of their entire year's revenue in the second half. They essentially have to double the performance of the first half. The CEO said they've already ramped up work significantly since the rain stopped back in October.
And look, this confidence isn't just based on wishful thinking. They say it's fueled by a really strong order book, and that includes some major new contract wins. They've just secured a 104 crore rupee project for the Agra water supply scheme, and on top of that, a massive 183 crore rupee contract for a sewerage scheme in Fatehpur. These new awards alone, totaling over 287 crores, give them a very clear pipeline of work that they believe will help them hit that incredibly ambitious second-half target.
You know, a single bad quarter can be pretty scary. But to truly understand a company's strength and its resilience, you have to zoom out. So let's put all of this recent drama into the much broader context of EMS Ltd's long-term history and its leadership.
And what a history it is. The CEO pointed this out on the call, and it's a really powerful point. The company has this remarkable pattern of growth where it has essentially tripled its revenue every 6 years, going back over a decade. From 107 crores in 2013 to 320 crores by 2019, and then up to nearly 1,000 crores in 2025. This shows a powerful long-term growth engine that one bad quarter doesn't necessarily break.
And they've achieved this through a really solid business model. They operate as what's called an EPC and O&M contractor. Now, EPC just means they handle everything for these big government projects: the engineering, buying the materials, and the actual construction. It's a turnkey solution. But the O&M part is also really crucial. That means they get contracts to operate and maintain these projects long after they're built, which gives them a really steady, predictable long-term stream of revenue.
Now, leading the charge through this very challenging time is a new face right at the very top. Harish Kumar Kansal was appointed CEO on the exact same day these tough results were announced. So he is the one who's been front and center explaining what happened and laying out the plan to fix it.
And you really have to look at his resume, because it is incredibly relevant to the job. He's a graduate from the prestigious IIT Roorkee, and he's a true veteran with over 38 years of experience in public infrastructure. But here's the most important part. He spent his career at Uttar Pradesh Jal Nigam, the very same government body that is now one of EMS's biggest clients. He rose all the way to chief engineer, which means he knows this sector, these kinds of projects, and the client's perspective inside and out. I mean, that is just invaluable experience to have at the helm right now.
Which, of course, brings us all the way back to our central question. So what do we have? We have a company with a fantastic long-term growth record that just hit a massive roadblock, which they blame on the weather. They've got a new, highly experienced CEO in charge, and they have a clear, if very ambitious, plan for a second-half comeback that's fueled by new contracts. So, the question remains, is that foundation of operational expertise and a strong order book enough to overcome this storm and prove that Q2 was just a blip on an otherwise impressive journey? Well, that is the story that the next 2 quarters are going to tell.